Thanks everybody for joining us. My name's Ida Rademacher. I co-lead the financial security program here at the Aspen Institute with Joanna Smith-Romani. And for the last 4 years, we've been really digging in on a conversation about the future of wealth. And we've been having a lot of the most consequential conversations about that here at the Aspen Ideas Festival. So thank you for joining us again this time. There's going to be a fabulous amount of folks in the audience who have deep experience and practice in these spaces. And we are going to be having most of the conversation in actual conversation amongst each other. So if any of you feel like, moving so you can see each other, feel free to organize yourselves as such, because you're going to be witnessing us in a roundtable discussing this issue of generational wealth. And hopefully, we'll have some opportunities to engage with you all. And I'm going to introduce my panel in just a second. First off, I'd love to see a show of hands in the audience. Who of you benefited from having some level of asset or inheritance? Great. And who did not? Thank you. One of the researchers at the forefront of the assets movement has said, and Michael Sheraton, in a book called Assets and the Poor, that assets matter in fundamentally different ways than income, and that institutions matter in determining who can build assets and who can't. Other research, recent research by the Richmond Fed, has shown that 26% of the racial wealth gap can be explained by a lack of inheritance. Certainly income is a huge part of that and other issues, but the issue of generational wealth and how you start and what kind of financial cushions you have is a huge part of the future of wealth conversation we want to be changing in America. The generational conversation about having wealth at the end of life to bestow is also consequential. It is the most meaningful thing as we talk to people about definitions of the functions of wealth. It was more important for them than their own retirement security. It was more important for them. It was the motivating factor, was that their children, or that they could pass on to their children and grandchildren something from which they could have a better start in life and a place for mobility and generational success in America. So we are starting this conversation today on the meaning of generational wealth, on the ways to build it for more people in America, as by the show of hands. I'll just one quick fact, white households are 10 times more likely to pass on an inheritance than black households. And when a black household in America gets an inheritance, it is 10 times less than a white household. So there are, and then we are going to start with the fact that the Ideas Festival itself thought it was a very provocative idea to name this conversation artificial inheritance. And that in and itself became half of the conversation that we talked about in planning this, because, of course, the idea that there's any natural inheritance in a country of laws and systems is kind of a funny one to begin with. But the idea that you could actually be intentional about manufacturing inheritance would be fun. So let me tell you who's here to be very excited about this conversation and let it take lots of turns together. So I'll just go across the board here. So to my left, to your right, is Dara Eskridge, CEO of Invest. Is it Invest STL, or do you say STL? I always want to say St. Louis. I will not. It's Invest STL, and you can tell us all about what that is. To Dara's left is Santosh Ramdas, who's the CEO of Gary Community Ventures right here in Colorado. Then we have Kirsty Furco, who is head of diverse segments. And I want to get it all right, Kirsty, you know this. Diverse segments, representation and inclusion at Wells Fargo, which is actually, a P&L line in the Wells Fargo portfolio, which is a really interesting institutional approach to this work. And then on the far side here, Damien Dwin, founder and CEO of Lafayette Square. Thanks so much for joining us, Damien. I actually want to start, I threw out a couple of reasons that researchers and then any of this room has an appreciation for a conversation about why you would start a conversation about wealth with a conversation about generational wealth. So, feel free to start the conversation with each other around this issue of artificial inheritance and why even the conversation about generational wealth should be something we all talk about and, more importantly, think about solving for in America. And we can start, why don't we start, Christy, with you? I'll go, you guys are in lovely tan, so I'll go Christy, Dara, and then we'll go Damien, Santosh.
Yeah. Well, I'll start with a personal story, actually, to get this started. So George Floyd had just been murdered, and I was president of mortgage at a bank in Detroit called Flagstar Bank, and I was pretty devastated, as I think almost all of us probably were, having witnessed that. And I think for me personally, it was this recognition that my blackness made me uniquely vulnerable in this world. And it was something I hadn't contemplated prior to that. And I'm optimistic by nature. So that whole week, I was just in my head about, what do I do? How can I be a part of the solution? And I just kept hearing, you're where you need to be. It's housing. It's housing. And what kept resonating was home ownership is still the single largest wealth-creating opportunity in this country. And it was like, that's where you are. But I also kept hearing big, big. And so I was talking to my CEO, and I was like, I feel like we need to do something bigger. Well, 1 week to the day of George Floyd's murder, I got the call about the CEO of home lending at Wells Fargo. Wells Fargo's business was 10 times the business that I was running at Flagstar. And I was pretty emboldened in my interviews when people said, why do you want this job? I said, because I want to put more black and brown people in homes. And much to my surprise, everyone I interviewed with said, great, come do that here. And I was like, oh, really? Okay. And I was like, no, but I mean it. Like, I'm like one of those people, like, I'm going to do it. So if you're really not serious, then please pass. And I got the job. And it was so interesting because I came in, and then fast forward, I'd been in the job about a year and a half, and April of 2022, our CEO, Charlie Scharf, had said, you know, we made $420 million off of the PPP funds coming out of COVID. And he said, we're not going to spend it. We're going to give it all away because we didn't earn it. We didn't do anything to earn it, so we're going to give it away. He said, I'm going to give you $150 million. What would you do with it? And I was like, well, let me think about that and come back to you. And the idea we came back with was a special purpose credit program. And we looked at our servicing portfolio and saw that we had 60,000 black families in our servicing portfolio that had not refinanced. So for whatever reason, interest rates were sitting at 3.5%. They were still in our portfolio sitting at 7%, 8% and had not refinanced. Some of them had tried and been declined, but most of them hadn't even tried. And they're sitting in our portfolio, so we came up with a special purpose credit program, which is a legal vehicle to differentiate on the basis of race. And we targeted all the black homeowners in our portfolio with this special purpose credit program. We went to them and said, whatever interest rate you're sitting at, we're going to buy down your interest rate to 3.5%. We're going to pay all your closing costs, hence the $150 million, to do the buy down. Because, again, we were in a rising rate environment now. So the prevailing interest rate was 6%, 7%, even went to 8% at one point. So we used the money to buy down the interest rate to 3.5%, and we paid all the closing costs. And those families, the program now, fast forward, the program has helped 6,300 families who are now sitting at a 3.5% interest rate in our portfolio. That's real dollars to real families, but it's not only, like, that's not creating homeowners, but that's preserving homeownerships and giving them this opportunity through this horrible economic time that was COVID. If people had been laid off, they now could actually take that difference in interest rate, put that in savings, and reapply it kind of in their families. And so for me, that solution really is about home ownership and getting these families to think about the generational wealth aspect of being able to have something to pass down for your family. So the importance of maintaining that home ownership, but then being in a position to be able to transfer that down. And then the next iteration of that, we moved into purchase. And so now we have started a special purpose credit program, which is focused on purchase. So we offer a $10,000 down payment assistance to be able to help families get into homeownership with hopefully the same intended benefit.
Feel free to discuss that, move into the pieces of your starting point, because I think people would love to hear what you're doing and how it relates to generational stuff, Dara.
Yeah, and I appreciated so much of that story. Ida, you said it at the beginning, but I really need to emphasize that all inheritance is artificial. And more specifically, it's unnatural. There's not a single instance in nature that I can think of where one is able to enjoy the harvest or the honey without laboring for it. For those who inherit it, wealth was manufactured on the assembly line of extraction and selective redistribution. So what we really need to do is expand that assembly line so that we can get wealth to all of America to deliver on its promise. Now, why I really believe in generational wealth is in my pocket. So I'm really nervous. And my children like to give me grief every time I leave them. So I always bring them with me. So my son, this is a Pokemon card that he invented. There's like 300 Pokemon already. He invented 301. And my daughter wrote me this very cute note. I love you, Mommy.
Oh.
So Theo and Ray, when you watch this recording, Mommy is always thinking of you. But this is why I believe in generational wealth. They are too brilliant, too inventive, too generous, too kind, too beautiful for this world to not see all of their gifts and the gifts of those that come after us. I can go into all the science of it, but that's really what it comes down to, the humanity of our people and how we invest in them for generations to come.
First and best dressed out of the two of you. Which one wants to jump in?
No, baby, go ahead.
I have a different take on this. We have about 150 million workers in the United States. 50 million of them are employed by companies with $1 billion of revenue or less. 240,000 companies in that addressable market. We call it the middle market. And the data shows when you stratify the wages of those workers, the top 20% utilize their company offered benefits, health and retirement. The bottom 80% use their existing healthcare and retirement benefits 20 to 30% of the time. So I just want to start with the basics.
Yep.
We have 50 million people employed by 240,000 companies. We know half of them live check to check. And so before we talk about wealth, before we talk about inheritance, before we talk about lifestyle, I think we have a tremendous opportunity as a society to bend capitalism in the direction of our working class people and our working class places. The data shows today, private credit, an asset class I know a lot about. I'm Goldman Sachs trained leverage finance professional. I've been an entrepreneur in financial services for years now, and I have a big business lending to small, medium-sized companies. We have a dynamic now where private credit, one of the hottest asset classes around, invests 50% of the money in just 5 states. So if you're a company, one of the 240,000 employing the 50 million people, if you're a company headquartered outside of California, Texas, Florida, New York, or Illinois, your cost of capital and your availability of capital is artificially high, and that undermines your ability to pay a living wage and to grow your business, which touches the people. So my view, my ambition, and I do this on behalf of our shareholders at Lafayette Square, is to drive as much capital, services, and technology as we possibly can in working class places and to working class people. And we believe if we are successful in lending money and curating, because remember, this is not a one-size-fits-all situation, curating appropriate services that intervene in these places to these people employed by businesses in specific industries, we can then reduce turnover and increase adoption of company-offered healthcare and retirement benefits. And that looks different in Topeka than it does in Westchester, than it does in the Florida Panhandle, and that's okay. Here at Aspen Institute, you can't go 3 feet without hearing about artificial intelligence and machine learning. So we're smart enough, on the one hand, to use big data to perfect stuff that I would say is sometimes trivial. Why don't we use that same skill set aligned with services and capital to bring interventions in places and to people where we know it'll be good for everybody? This is a pro-America agenda. It works for Republicans and Democrats. It works in big states, small states. We cannot have a capitalist system where the money goes geographically to a handful of places. And that issue rhymes with everything that we're talking about in the way of an inheritance. I would say, for whom? I'm focused on an inheritance for working class people and working class places. And I think the front line of that fight is the 240,000 companies that employ 50 million people. I want to get the benefits gap closed first. And then I think we're in a great position to address things like housing. Housing doesn't work if FICO scores aren't up, if savings rates aren't higher, if the stability of employment isn't there. And so I want to call that out and see that we do more in that space. And I think we can do it profitably because fact of the matter is they're just phenomenal lending opportunities with and for working class people and working class places. Today, our capitalist system and private credit specifically is dominated by private equity, and that is problematic. We need to focus on entrepreneurs.
I'm going to have you jump in, Sanjos, but just to clarify for folks too, everybody up here is deploying capital in some way toward this issue of stability, resilience, ultimately wealth creation, and the idea that it's going to lead to also kind of wealth transfer, right, as a starting point so that the cycles perpetuate differently. So I haven't called out the different ways that people are deploying capital, but those are going to come out, and they may be some of the kinds of questions you might be thinking about too in terms of what are the tools in a toolbox to really grapple with this conversation and this issue at a national scale. But Sanjos, I do that as a setup to you to say a little bit about both the frame of this as artificial or not, and why generational wealth is a framework or a motivation for the kind of stuff that you're doing.
Yeah, I want to take a more philosophical, reflective view on artificial or not, and then also talk a little bit about personally why this matters, because I think that drives a lot of our work. Dara mentioned it before, nothing of this feels natural, right? All inheritance is artificial, and I don't think you naturally build a system where top 5% of the country owns about 65% of all the wealth. That doesn't happen naturally. And thinking about it, it's built on stolen land, it's built on stolen people, and it's built on stolen resources. And that, to me, is the foundation of how we think about wealth in this country, but we often forget about it. And the thing that I was reflecting on is the analogy to AI, which is the other artificial intelligence. And I'm a prolific user of large language models. Every day I use it in my work, and we often forget that that's actually built on stolen knowledge. It's stuff that you all put in, and something that you put in a Reddit forum 2 years ago is actually being fed back into knowledge for you. We don't know that. We call it AI, and it comes in a snazzy way. And those of you that raised your hands about not having inheritance passed on to you, your inheritance is in the hands of somebody else. And that is the beauty of how capitalism is structured in this country. And we often forget that that extractive form of ownership is the cardinal sin of capitalism in this country, but we still take it for granted. And I often think of it as a matrix. We can't question it. I think we think of it as that ownership is not something that you can really play around with, and nobody tells you that it's the dirty little secret, but that's the only way to build wealth, right? So that's what drives our work, because I work for a family office and a private foundation where our belief is that really our assets should go away. And our assets shouldn't go away in a way where we give it away as a handout. Our assets should go away where we become a wealth engine for the community. So we're working towards what we call an asset transfer or a community wealth building, where we can move from our balance sheets into the balance sheets of community and individuals. And I think that's the real challenge in front of organizations that are asset holders, philanthropy, and private wealth holders in this room or otherwise. And I think personally, I do want to make a connection to one other factor, which is that I didn't grow up with wealth. And my mom was visiting me recently, and I was realizing that a lot of her parenting, she wanted to be a great parent, but a lot of her parenting was driven by uncertainty and this fear of like, oh my God, what am I going to do? I can't cover. And for me, I was thinking of what wealth means for me. And I think when I go back home tomorrow, it's my daughter coming back and giving me a hug. And part of generational wealth is also generational trauma. And we pass that along, communities do. And we forget that wealth is often we think of wealth to be about nice things and fancy stuff, but it's always about stuff that is love and trauma, and the struggle between those two. And I think we should remind ourselves that it's not something that's a nice thing to have.
Yeah. I definitely am. I'm going to be sharing the moderator role because I want you all to query each other in your things. We've named a couple of different tools that people have said had a preferential option in terms of their own sense of impacting wealth and generational wealth. Christy, you mentioned homeownership as the first thing that really strikes you, and it is true. If you looked on the household balance sheets of America, for the bottom 80% of the population, it's really the only form of wealth, and well, none of that shows up in the bottom 50% almost, and then but it is the largest form of an asset on the balance sheet in America. You mentioned business ownership and entrepreneurship, but also the quality of the jobs and the stability, reliability, income, and the benefits packages, right, as part of what we call the wealth escalator, if you will, in this country, right? And the disparities in the benefits place, which you've been very, many of you are on, has been a part of that you might want to call out more. So we've heard about home ownership and business ownership. I wonder, as we're filling out the toolbox of some of the tools that would be contributing to a possibility of generational wealth for all in America, what are some of the additional tools that you are excited about, building on, thinking about, scaling, piloting? Discuss.
I would love to just pick up on this conversation because you certainly referenced, kind of FICO score and, having people really focus on improving their financial stability. And then you introduced this whole notion of financial trauma, which I think is so important. And one of the things with the gap and how significant the gap is today, it is this recognition that we have so many people who are living paycheck to paycheck and who can't think about, the notion of wealth is so crazy, like your mom, because they're just in fear of, how am I going to pay the bill tomorrow? Or do I have to skip paying rent because you need shoes or, some other bill is due? And so that transition, and so I wonder if the start of this conversation as well is about how do we start to think about kind of financial education in a way that really starts to level the foundation of, not only do you understand your credit score, but can we start with the basis of debt reduction, increasing your savings, improving your credit score as a way to start to think about this whole notion of how do you move forward and empower people, and you have to deal with the trauma in order to, and people's issues and trauma with money, to be able to get into that conversation. I wonder if there's a place there to really start to think about, how do you start with the stepping stones? Because you can give someone inheritance. If they don't have the basics, they're not going to be able to maintain it, and that's what I worry about.
So that's true, if you don't mind me jumping in.
Yeah.
And what I'm concerned about the field is the discourse is we either have to do stability or we have to do wealth building. And these things have to happen all at the same time,
Yeah,
right?
it's
It's a
and.
both and.
Yes.
So one of our pilots in St. Louis, there's a neighborhood, the West End of Visitation Park. It's rapidly gentrifying. This is a neighborhood where back in the 50s, Black families were displaced too because their original neighborhood was leveled for a university and the predecessor of Wells Fargo and many other things. And so now they're seeing the signals of, oh no, this neighborhood is changing. It's no longer going to be for me. And they're concerned about that. So we're actually piloting direct household investment as an anti-displacement strategy. It's a pilot, so it's small. By random selection, 50 households receive $22,000 virtually lump sum. $2,000 of that is immediately upfront for debt mitigation, immediate needs, put it in the savings account, whatever. And then the $20,000 is for them to go and invest in themselves, buy a property in the neighborhood. I'm in St. Louis, so the cost of living is much lower, right? Buy a property in the neighborhood, fix up a property in the neighborhood, invest in a business in the neighborhood, and or put money in an investment account. And with that, yes, we've got credit coaches, they're pulling their credit reports, but also they're working with financial planners, each and every household. We're going through the chain of deeds and clearing title. They're having the long-term conversation around what are their family's dreams, while also talking through, okay, how do we make the most of our benefits? How do we make sure that the next job opportunity is one that actually gets us towards wealth building versus just cancel out the benefits and we're right where we were before? So it's really critical to do the both and.
And I think we want to reframe this conversation, Christy, that there's a moment of stability and certain level of income before we can start having a conversation around wealth with families, because I don't think that we're going to get there. I feel like most families are struggling, and I feel like it benefits the extractive enterprise to keep people as not owners. The more people are not owning homes, those homes are owned by somebody else, and they're definitely. And so this idea of that is the matrix, right? Like they've made us believe that, oh no, you can't be a wealth owner yet because wealth as a conversation is only available when you make $200,000 of wealth and income and all that, right? The truth is, similar to you all, we have a special purpose credit program in Colorado, and for black homeowners, 90% of them are paying a lower mortgage than they were paying on rent before.
Yes.
And so the truth is, it actually makes a lot of sense even if you're paying rent. And these are folks making less than $65,000, $70,000 a year. These are not folks making $150,000 in Denver. And so I do think there's a conversation where opportunities where people create economic value in our daily lives, and how do you share some of that prosperity. And one of the more exciting pilots we're looking at is sharing ownership in multifamily housing, where you can get multifamily owners to say, take a small sliver, it doesn't have to be a big part of it, you wouldn't even notice it, and give it back, and that might become a $5,000 kitty for them in 2 years, and that matters. And so that's why we gotta find ways to create wealth naturally without making people feel like they have to jump through multiple hoops before we get there, because that's a disempowering conversation.
Are there other, I just want to unpack the generational wealth toolbox, as it were, that you all are thinking about in your own work or what you're following in the spaces. So, because I do want to anchor this on the idea that net worth from birth might create a fundamentally different set of trajectories around some of those things. So I'm just wondering if we fully kind of like assembled the toolbox that we have to work with, or that we're dreaming of in terms of this question of generational wealth.
Okay, I'll add.
And
Well,
pilots
yeah.
are things that you're like watching and following and looking at
Yes.
the evidence and being, holy shit, we got to do that
Yeah.
more.
So we've talked quite a bit now about housing, and home ownership is critical. But if you're owning a home in a black community, you're not going to have equity. So the other half of that equation is we have to dig into the appraisal model so that we're bringing up the values of these properties so they're not based in race valuation. So that's one thing. The other thing is a whole notion around baby bonds. We've got a number of states that have started adopting baby bonds. Connecticut is one of them. Where you're really endowing a person's future from the very time that they're born. And now we've got a set of states that are starting to do what I like to call junior bonds, delivering to middle schoolers a bond that will mature so that when they're 18, they can choose to put it in there, let it continue to mature, or they can take it out for their future. These are the kinds of ideas that I want to see us really replicating across the map. And so that we're not just focusing on adults, we're not just focused on the children, but we're really starting to endow generation after generation.
Yeah, the only thing I would add is data science and technology needs to be brought to working class people and working class places at industrial scale. Until we create a big tent that works for all stakeholders to play a constructive role in affecting change, we won't get anywhere. And that's true in real estate, it's true in corporate credit. We need to have conditions where we're all actually sharing the same information and agreeing on the facts. And right now, we're not even discussing the facts. I'll use real estate as an example. My friends at Isuzu point out we're short 4 million units anyway. So,
See him in the back of the room there?
if we're gonna work on solving a problem when we know the denominator is way too small to begin, right? Why don't we attack the structural problem? We need to build more housing in this country. And in that paradigm, you haven't created a villain. It's not calling one person bad or another person good. It's saying we actually have to expand the pool. And then within the pool, we need to start changing behaviors. And I think the easiest, most effective way to change behaviors is to have a utility, a data utility that is publicly available, where you can understand by zip code what's happening socioeconomically. Because what's happening in Colorado is different than what's happening in Florida. What's happening in Aspen is fundamentally different than what's happening in Denver. So let's be specific and really understand what's going on, not just with FICO, but home ownership rates, medical debt, student loan debt, mortality, education, and see the trends that go with that, and then come with customized, thoughtful solutions. At Lafayette Square, we're focused on 4 layers to the data journey. descriptive data, where we first have just the facts, what's going on, diagnostic data, where we take particular data sets regarding a problem. So Wells Fargo's mortgage portfolio, screened through the lens of what's happening in every zip code. Then you get to the next two more interesting, predictive analytics. Based on the facts, what can we anticipate might happen? You have to have a model to do that. The fourth and final frontier is prescriptive data analytics. Just as you would go to a physician to get medicine based on your symptoms, we can look at a community in Aspen differently than a community in Austin, Texas, and prescribe a solution which includes capital and services, things we're talking about here. But this customization piece requires that we first have a data tool that is a public utility that we can all enjoy, and everybody can come with their own perspective so that we're not talking past each other.
Yeah. I like this idea of the data tool, and then I think once you have that, it's how do we bring that together to be useful, right? And you talked about being able to do that at scale. One of the models, and I think about the importance of public and private partnerships to drive this forward. And one of the models that I've seen work is the OCC. They have convened what they call Project REACH. And REACH stands for, it's an acronym, but it's about the Roundtable for Economic Access and Change. And what they've done is they are the convener that has brought together public and private partnerships. And I lead the affordable housing work stream. That was in 1.0, and now they're transitioning to 2.0, which is focused on place-based initiatives and underserved communities, and they're repositioning that. But the idea is to bring people together to have this conversation about what are the tangible ideas that we can do and try in different locations to try to make this a reality that then we can start to scale across multiple companies, multiple industry. But where is the public policy decision that needs to be made to be helpful in this? Where is the government role and intervention in this? And then where is private capital coming to work in that? And it's been really powerful to see some of the ideas that have been generated through that. And one of the ideas we took on in the affordable housing workstream is around this appraisal and the consistency in appraisals, and can we get to a standard across, but more importantly, can you diversify what the appraisals look like and get people who are in those communities and understand value, but then also can you use data to be able to say that a 2-bedroom home with the following amenities, there's a consistency to that, and use the data to say where's the discount based on geography or proximity to water or what have you. But it starts to equalize and give a framework that everybody can use to. And that public-private partnership is something that really resonates to me. If you're going to solve it at scale, you've got to make sure that those players are at the table finding solutions that can actually.
Well, I don't want to go in a lay audit. You want to jump in on that? Go ahead.
No, why don't you jump in?
Well, I'm just curious. I want to zoom out a little bit, because what I would hate to do, and what I think we need to do in America, is make sure that the first order thing is that we all agree that what are the conversations we need to have, or what is the data we need that actually has everybody nodding their head that we're like, yeah, everybody needs some level of additional discretionary wealth and money in their lives to live well, and that the tools that we build at scale should serve a broader population than they do right now, right? That there's one population that's public programs and public benefits, but there's another that gets policy and tax cuts, right? Or that there's one population that is a worker, and there's another population that there's an owner. Or there's one population where we get very good at helping them manage their scarcity, but there's another population that we facilitate and see how systems can help them build wealth. So I'm curious if enough of the people are looking at the same data or asking for the same data, or even who's wanting to look at that data for the purposes of shared prosperity. And I tend to think of shared prosperity as, like, if it's not showing up on the household balance sheet, then we haven't done it yet, right? That the idea of shared prosperity really would have to be a tangible, measurable thing at a household level, that both their cash flow statements are looking better and their asset and balance and debt balances. So I'm just curious for you all, as you brought along your own stakeholders, who was the hardest to bring along, or where are you in the changing the conversation to be one of more deeply shared prosperity as a place where you can drive capital and you can get bigger coalitions going in that direction.
Yeah, I can jump in, and I want to pull a thread from what Damien mentioned. And maybe we're in slight disagreement here, but I will honor your points. But I would say that the data is already there, and I feel like both on the broader narrative, we know that it's not surprising how concentration of wealth in the United States is. It's part of the mimetic value, everybody knows it. And data is at a microscopic level. If you're a multifamily condo developer and you own a building, you exactly know who your renters are and how much money they have. Because you basically full on screen them before you let them into the buildings, right? So it's not like it's not there. I think the hardest part of this is market actors. And I think there's a fine balance between how do we not alienate them and keep them not so scared they don't run away, as against holding them accountable as folks who are extracting value and wealth out of these communities. And I think that's the harder part of the conversation. And to me, that's where it is going to be the much harder conversation, because the way the markets are structured today, it is not designed towards creating value for those generating economic value. So for instance, we looked at our own portfolio. We've been around for about 12 years. We're about $500 million in endowment. In the last 12 years, we paid out about $100 million in wealth to fund managers that we work with. These are folks right next to us. They manage our money. We appreciate them. And then we looked at the value chain, and maybe there's a bunch of money going out to CEOs or all these company owners, et cetera, or owners of multifamily properties in the real assets portfolio. It's across every asset class. But if you looked at the folks that are actually generating value, workers, renters, people that are actually at the bottom of this, $0 from our own share of wealth, it's gone into their hands. And that's the structure. And we are a mission-oriented, 100% value-aligned investor who hasn't questioned this, because we're like, oh, that's how the world works. And so how do you question that? And that is going to be hard, and that's going to be hard conversations, because if asset holders don't make this as part of a priority of the conversation, it's going to be hard. And I don't still think it's going to be easy, because this is a structure of our capital markets that is so strong and so powerful in being extractive.
I mean, look, a disagreement on this is but what we can't have is people not talking to each other because they disagree and don't want to offend each other. So I'm quite happy to be, like, I wouldn't say offensive, but I would say this idea of where you are playing in the capital markets. You're creating a new big business where you think there's growth in these spaces, and you are too, Christy. So these are places where this is the Ideas Festival. So let's have them out here for people to be pondering and questioning and debating the rest of the afternoon.
Sure. So I got a thick skin. I mean, so.
and I would say also in the spirit of 12 minutes, and we've got 4 of us here, pithy is good too in the conversation with each other.
We could do this. We do this in 2 minutes or less. This is America. You have to make money. Period. And there's nothing more attractive in America than making money in ways that also help people. You see, they even cut my mic. That's my point. Right? Yeah. There's no conspiracy afoot. Okay? Make money serving working class people in working class places. And I do fundamentally disagree and dispute the notion that the data is out there and people know. Show of hands, how many people in this room have invested 10% or more of their personal portfolio in working class places? This is my point. Hey, you see, I just proved it again. We don't even know the definition of working class places, right? The definition is low moderate income, which is a federal standard, 80% of area median income or less.
Well, let me ask a question with this, and you go ahead, but I'm curious about make money. Some of the models out there to make money might need a different kind of capital stack that has a blend of capital to make it work over time, or to make it work for people who, I'm just curious if there are places where it's not complete disagreement, but if there's places where what are the additional models that can make money in this space?
Without concession, capital's not flowing to 45 states the way it should. So let's take the first basic step of actually showing up in communities and giving them a shot. And this is where I want to hold stakeholders accountable. My dad was a bus driver in DC. And if I asked my father where his retirement dollars went, he couldn't tell me geographically where they went. But I can tell you, my father's money was exported from DC to New York, Florida, California, Texas, Illinois. And none of my father's retirement was sent to working class people, working class places, something that deeply aligns with the arc of his personal narrative, because he didn't know, right? So I'm calling it out. There are great investment opportunities in the DC, Maryland, Virginia area where my father paid taxes and drove a bus for 30 years. I know you can make 10, 12, or 15% net with low volatility in DC. And I could show you the data on the entrepreneurs who will raise their hand and say, if you invest with me, I'll be a great steward of that capital. I'll risk my family's net worth and create jobs. The money does not have to go to Texas. And so where are we in holding ourselves accountable for directing money geographically and socioeconomically? And I think that requires data science and the alignment of services that also enrich the money, because money alone won't do it. You got to show up in each of these communities with customized services to either reduce turnover, boost adoption of services, get people on the path to home ownership. It's always, situational, and we have the tech and the insight to attack it differently under the existing rules.
So I'm going to disagree with, I'm on your side and disagree with you. Santosh. Like,
You're all crowding capital into the places you're talking about. I
Right,
just want to
yeah,
point that
yes.
out, that there's alignment there.
and
so-
we all have all the data that we need. We know that some people have many generations on, and some people don't. That's all the data we need. We're not making wise choices or moral choices about how we spend our capital and direct it. And so, Santosh, you talked about endowments. I think from a policy standpoint, that's a big area where we need to make some policy strides, because institutions that enjoy nonprofit status are stashing away today's capital for their own relevance tomorrow, not understanding that the deficits of today compound with time. Would you rather fill a pothole or a sinkhole? Spend the money now. Invest in our generations now.
And thank you. And I'll also add, Damien, love you. I think you're awesome. The work you're doing is great. My worry is, from our side, there's a lot of capital going into working capital places and people. That capital is it's not the kind of capital that you guys are deploying, right? Even if you think about black and brown neighborhoods in all of our cities, the fabric of those neighborhoods have dramatically changed. You're seeing high-rises, you see condominiums. Sometimes they call them opportunity zones. Where do you think that capital is on the balance sheets of wealthy folks and foundations, and that capital is going into those communities? I think it's extractive. So it's not just where it's invested, but how do you share the prosperity and the wealth? And I think that's going to be the hard part. And I know you all are moving the needle on it, and you might be like, look, the starting place is even to get the capital there. But my worry is that there's lots of capital there because money will flow when they see opportunity, and that's there in these communities. I just worry that it's not doing the thing. It's actually doing the opposite of what we need them to do.
Well, it's also about, the customizable solutions that you can scale. And so we do have these examples where capital is being utilized in certain areas, but it may be benefiting that, or it's not reaching its full potential. And so how do you understand what the model is in those areas that then you can extract to other locations to be able to then build on those ideas so that you're helping more in the communities? And I think that's the thing that we've struggled with a little bit. We're trying different things, and we are providing access. I think entrepreneurship is a huge place where you can start to empower people to take control of their own and provide the access to capital. But then again, it's thinking about what are the models that you're going to be able to scale and help across. So some of those investments, it's a place to start, but then we have to figure out how to continue to lean in a way that can then be duplicated across multiple geographies.
One
And I don't
quick
think we
thing,
figured that out.
just to compliment how we're in violent agreement, and I love you dearly. Passionately.
Should I sit down?
Absolutely not. Absolutely not.
We need to get out
I
of
feel like there's a little love thing
Yeah,
going.
so at Lafayette Square, we established 2030 goals. We've committed that by 2030, we will create 100,000 working class jobs, invest 50% of our money in working class places, we talked about the definition, and see that half or more of our portfolio companies adopt services that reduce turnover and increase healthcare and retirement benefit adoption by the employees in the businesses we finance. We publish the zip code of every company where we invest money, and we disclose turnover, wages, healthcare and retirement benefit adoption for all employees and all businesses. I would submit that is not just a reasonable place to start if I'm simultaneously delivering market or market plus returns. I think it starts to attack the elephant in the room, which today is working class people and working class places are a bad bet.
They don't make money, yeah.
Okay, so I want to change that so that working class people and working class places are perceived as a smart bet. That requires making money, and data science, which is made so readily available, it gets into the subconscious of all stakeholders. Because in every scenario, I've concluded we have to create a big tent where everybody feels like they're not a villain and they can be a part of the solution, and they can see working class people get on that escalator.
There's a lull here for a minute, and we have about 5 minutes left. I'd like to hear a couple of questions from you all, and ideally they are questions. So you asked, so you get one, and you get one, and you get one, and let's hear all three questions, and you get a prize, and you get a prize, and let's hear all three questions. And I do want to seed for you all, though, each of the strategies you're talking about, we started this with the generational wealth concept. There's some sense of which this lands in a conversation about how do we end the levels of disparity that perpetuate in this country. So I just want to plant that seed as we come into a closing lightning round, where what we have as a prescription or a call to action in that space. And we might answer your questions too, so let's hear it.
Great. First of all, thank you to all four of you for doing what you do every day, because you're fighting the right fight. We have to make capitalism work. And unfortunately, people use the argument that, question's coming, that data is there and capital flows. Damien, you said public-private partnerships too. You described the role of government, the private sector, and civil society. How does that work, and how does foundations work? How does philanthropic work in partnership with the private sector here?
So don't answer, we're just not hear all three for now, just so we can get them in. I'm curious what kind of questions are here.
Hi, I have a question around home ownership and investing for middle-class, modern, low-income families. We're in a very difficult time right now. We have high interest rates if you want to purchase a home. Many people are losing their jobs. Many people, investors like Blackstone, they're seeing home ownership as irrelevant for most of America, and they're using single-family housing as an investment opportunity. So that's further pushing home ownership further and further away. So how can we hold those, I don't want to call them bad actors because we are in a capitalistic society, so they're doing what they feel is best for their stakeholders and investors, but what about the people that's going to be impacted and can't? So how can we address some of that's happening, the system that needs to change in order to make what you all talk about a reality?
Great question. And then one question over here.
Sorry, that was pretty much mine. How do you feel about corporations owning single-family homes, and how does that impact the transfer of wealth in real estate?
So I'll boil those down for you. I think there's one here about public-private partnership. I don't know. You don't have to necessarily answer it. I'd say whoever feels most strongly about answering why and how, that's a piece of the toolbox. And the other one would be in this race for shared prosperity. If the deck is stacked at the moment on those, and some of the kinds of assets we've been focused on are becoming more and more out of reach, what do we do about it, or what alternative tools are we excited about looking at? I'd say those two things are the ways that I would summarize answering those two questions briefly.
I'll start just on the home ownership one. I think corporations owning single-family properties is an outgrowth of the housing crisis that we had in kind of 2008 and 2009. I think there are openings now where, as people are looking at their portfolio and seeing where else can we Where else can we invest? I think there's an opportunity, especially with housing affordability and limited supply that's happening in the market. We are supporting a number of people who are looking at funds, looking at those portfolios and saying, how do you take the LMI in that portfolio, and can we invest in partnerships where people are buying that and we're providing equity capital for them to go buy those, and then do like rent-to-own programs in those communities where people have been paying that rent, and then can we do rent-to-ownership models where they can then start to own those homes. And so I think as those corporate investors start to get rid of some of that capital, or we're empowering stakeholders to be able to do that, I think there's an opportunity to open up that aperture for it. The last thing I'd say, I think that addresses your question a little bit, is in some of the markets where there is better housing affordability, I'm talking to people about looking at what people are paying for rent and look and saying, can you get a duplex? So don't just think about single family, but can you think about, well, the definition of single family is 1 to 4 units. So can you start to think about a duplex where you can then purchase that, get in at the same or close to what your rent is, have somebody on the other side that's helping you pay your rent. And so that's starting to help. And it's just different models to get people to think about homeownership in a different way.
I would add to that also, a lot of our cities have land banks that have homes that are available, and that's another route to getting to home ownership, so that you're not putting so much towards the purchasing of the home, and you can put more towards making the home comfortable.
I would say there's meat on the bone. There's evidence that there are federal and state programs that are not fully exploited. We named our business Lafayette Square because we believe in government adjacency, public-private partnership. We do a lot of business with SBA. We're looking to do more. And I think there's cash left unclaimed in DC where we should be leaning into that. The second is I'm very hopeful and optimistic that working class people will stop exporting their money and giving it over to places and to people that don't share their values. I think there's a lot more money that working class people have influence over that is unclaimed, and we need those behaviors to change at our unions, at our pensions, so forth.
Mm-hmm. But I think that goes full circle too, but it's about education, because I also think they don't know that, right? When you say stop giving your money and exporting your money, I don't even think people have the awareness that that's what they're doing. And so the education is.
But they're trustees with a fiduciary obligation.
Understood.
Let's get
This is
Santosh.
this is our best in our budget.
Let's get Santosh in the mix as we're wrapping up here.
I think homeownership is the key. We do have to think slightly outside the box to say it's not the same thing for a family that can't afford to get into homeownership as it takes for a family that can. And I do think down payment assistance is the key. So for the Deerfield Fund for Black Wealth, which we run in Denver, average black family gets about $50,000. And that is the kind of money that you actually need to start competing in a market when you're competing to buy a home. And then I want to take a step back to the question on capitalism. And I want to say I love capitalism as much as I love banking. And my day job is running a private foundation and overseeing our assets. And I think part of the responsibility starts with me. I think asset holders, we sit at the top of the pyramid. We control our assets, whether it's foundations, pensions, institutions, and high net worth individuals. And if we don't start asking slightly radical questions, slightly questioning the system as it is, then nobody else is going to in the ecosystem, because we hold the power in terms of deciding where to put our money to work. And that's why I'm trying to be slightly contrarian to say, yes, how can we make sure every conversation that we have with every asset class and every manager, we're asking them about wealth and ownership? Because there is equity being held by somebody. Why don't you take a tiny sliver of that equity and start sharing with people creating economic value? And if that becomes part of our normal conversation, like gender lens, like climate lens investing, then we might see a completely different America in terms of our wealth and ownership. And that's why I think I want to push the needle to say, it's not just about trying to work with the way markets they are. How do we make sure markets to behave slightly differently than they are right now? And I think it starts with people like me.
I'm going to say that's a good wrapper for our conversation. If you all are interested in, thank you, all of you. When I say we're changing the conversation about the future of wealth in America, I didn't say it was all pretty and kumbaya. And I think we're committed at Aspen to continuing to have the hard conversations about the future of wealth. And I have a lot of fans about that. There are barcodes on your seats if you feel like knowing about a lot of the resources there, or getting in touch and knowing more about all of the work of the leaders here and so many that are in the room. We'll be continuing to share that work. So thank you all for coming, and thank you so much for being part of the audience.